Welcome back to the deep dive. You know, if you've ever looked at a company's annual report, it's this beautifully bound document showing soaring revenues, you've likely asked yourself the big question.
The fundamental question of finance, really.
Can I actually trust these
That
numbers?
is the core challenge. We're
Yeah.
talking about a report that's prepared by the company's own management who have, every incentive in the world to present the absolute best version of their financial health.
From securing loans to boosting their personal bonuses?
Exactly. So our mission today is to really dive deep into the mechanisms designed to bridge that gap. We're talking about the role of the external audit and the truly essential information that's often buried, not in the main tables, but in the notes.
Okay, so let's start where all financial analysis has to start, the language itself. At its simplest, accounting is just an organized system, right, for recording thousands of daily financial activities and then summarizing them.
Right, into three main statements, the three core outputs that every single company has to produce.
And the first one is the balance sheet.
The first, and maybe the most misunderstood, we want you to think of this as a single high-definition photograph. It captures the company's financial position, its assets, liabilities, equity, but only at a frozen point in time.
So like December 31st, a single day.
A single day. It's static. It doesn't tell you how they got there, just what they owned and what they owed when that picture was taken.
By contrast, then you have the income statement. And if the balance sheet is a photo, this is the movie.
It's the movie, exactly. The income statement reflects the company's performance. So the revenues they generated and the expenses they incurred over a whole period of time.
Like the last quarter or the full year.
A full year, yeah. It shows profitability, which is why it gets all the press, but you have to remember, profit is calculated using estimates and accounting rules, not just hard cash.
Which brings us to number 3, the statement of cash flows. This one is just pure reality.
It is. It tracks the actual sources and uses of cash, the real money coming in and going out over that same period. It tells you if that profit on the income statement actually turned into cash they can spend.
So together, those 3 tell the story.
They tell the story, but as you said right at the top, they are self-reported. So we're staring at a massive credibility problem from the get-go.
Let's tackle that head on. If management gets rewarded for good numbers, a higher stock price, bigger bonuses, and they're the ones making the report, why isn't every company just, inflating their revenues?
Well, because of what we call the incentive to bias, management's financial motives are just so strong that if they were left unchecked, the reports would probably be skewed, maybe intentionally, maybe not.
Imagine you're a company trying to get a billion-dollar loan from a bank.
Perfect example. If you can make your balance sheet look just a little bit healthier, that application gets a lot smoother. That pressure is always there. It creates what analysts call information risk.
And if that risk is there, the market investors, lenders, everyone, they won't trust the statements, which kind of defeats the whole purpose.
Completely.
So what's the firewall? What do we put in place?
The solution is the independent external audit, and it's performed by a certified public accountant, a CPA. This is a third party, completely outside the company, whose whole professional existence is built on providing objective verification of those statements.
And the requirements for these auditors are, they're intense. It's not just about passing the CPA exam, which is incredibly difficult, or having deep business knowledge. It's about this absolute non-negotiable need for independence.
It's the highest ethical bar in the industry.
Yeah.
An auditor cannot have any financial relationship that might compromise their judgment. For instance, they can't own a single share of stock in the company they're auditing.
And what do they actually do? They don't just read the report.
Oh, no. The verification process is exhaustive. They go out and perform independent checks. They'll physically go count inventory in the warehouse. They send letters to the company's banks to confirm the cash balances are real. They even evaluate the internal computer systems that record the transactions in the first place.
And for public companies, this isn't just a good idea, it's the law, enforced by the SEC here in the U.S. And this whole thing is governed by very strict standards.
Right. It's a dual system of rules. Companies have to prepare their statements according to GAAP, that's generally accepted accounting principles, and the auditors have to do their work according to GA's generally accepted auditing standards.
Okay, so that brings up a really important point. Once that audit is done, the CPA firm signs off on it. They issue that famous opinion, and they're putting their multi-billion-dollar reputation on the line. So what exactly are they guaranteeing?
They're guaranteeing two specific things, and we have to be really precise here. First, they certify that the three financial statements are presented fairly in accordance with GAAP. That means the company followed the rules.
And the numbers reflect reality.
Logically, yes.
Yeah.
Second, they certify that they, the auditors, followed GAS. In other words, that they did their job correctly.
Okay, but let's be crystal clear on the fine print. Because there are two huge things that opinion is not telling you. This is where people get tripped up.
Yes. The first crucial distinction is that it is not a guarantee of 100% accuracy. I mean, the sheer volume of transactions at a company like Amazon or McDonald's is just staggering.
They can't check every single cup of coffee sold.
They can't, so they use statistical samples. They certify there are no material misstatements, meaning if there are errors, and there will be, they are small enough that they won't influence an average user's decision. Small errors absolutely exist.
So they're guaranteeing there are no big things wrong.
That's a good way to put it. Correct.
Yeah.
And the second distinction is maybe even more important. It is not an investment recommendation.
Right.
The auditor is explicitly not telling you to buy the stock. They're only certifying that the statements fairly reflect the company's condition. If the company is weak, the auditor confirms that, yep, these statements accurately show that weak position.
That makes total sense. They're verifying the odometer reading, not telling you the car is a good buy. So here's the puzzle for me. Over 99% of audit opinions are clean. They give the all clear. If they're so rarely finding massive fraud, why bother with all the expense?
Because the value is less about catching fraud and more about prevention. It's the powerful deterrent effect. Management knows all year long that the auditors are coming at the end of the year. And that knowledge forces them to maintain disciplined, transparent, and rigorous reporting systems from January 1st.
So the threat of the audit keeps the books straight throughout the year.
Exactly. It reduces that information risk we talked about. It's just the cost of doing credible business in the public markets.
Okay, so now we have to move to the obvious next question. The one that makes every skeptical person, twitch. The conflict of interest.
The big one.
The company being audited, let's say McDonald's, is the same company writing the check to pay the auditor. I mean, how do we trust them when their paycheck depends on keeping the client happy? Isn't that deeply unsettling?
It is unsettling. And look, it has caused huge problems historically, but the modern regulatory environment, it's set up with these really powerful counterbalancing factors that, for the most part, win out.
Okay, what are those factors?
The first one is simple, reputation. We're usually talking about the big four firms, Deloitte, EY, KPMG, and PwC. Their entire product is their integrity.
Their word.
Their word. If one of these huge global organizations signs off on fraudulent statements, they risk their whole global brand. They're not going to risk their firm's existence, like what happened to Enron's auditor years ago, just to keep one client happy. The fee from one company is a rounding error compared to the value of their reputation.
So their brand equity is the real safeguard. They lose it all if they get it wrong.
Precisely. And the second factor is litigation risk. If investors lose money because they relied on bad statements approved by the auditor, that audit firm faces massive lawsuits. We're talking hundreds of millions in damages.
Wow.
This threat forces them to be incredibly diligent. A lot of the work they do is to protect themselves from that future claim that you should have warned us.
So the economic incentives are actually stacked against being lazy. They have a bigger incentive to do a fantastic job or even just walk away from a shady-looking client than to just rubber stamp a report for a fee.
That's the system. It ensures the numbers on the statements are reasonably trustworthy, but if the statements are the headlines, you can't really understand the story until you read the fine print.
The footnotes. They always look so tedious, but I've always heard that's where the secrets are. What are we actually looking for in the notes to the financial statements?
The notes are basically mandatory context. The dollar amounts on the statements are just summaries, but the notes provide the detail you need for real analysis. And they systematically answer 4 critical types of questions.
Okay, let's decode the first type. Summary of significant accounting policies. What question is this one answering?
This note answers, what specific and sometimes subjective accounting rules and estimates did you use to get to these numbers? This is fundamental for comparability.
Right.
You need to know if company A expenses its inventory using one method, say FIFO, and company B uses another, like LIFO. Both are allowed, but if they use different methods, their profit numbers are not directly comparable.
So if I'm analyzing 2 competitors, I need to check this note first, just to make sure I'm comparing apples to apples.
Absolutely. Or think about a company like Disney. Their note will have these intricate details about how they estimate and expense the costs of their giant film productions, often based on something called an expected product life cycle. That's a huge management estimate that directly hits their net income.
And you need to know what formula they chose.
You do.
Okay, next note type. Additional information about summary totals. This sounds like the zoom in button for the numbers.
It is. It answers the question, what are the important pieces that make up this one big number? So you look at the balance sheet and you see a single number for inventory. This note breaks that down.
Into raw materials, work in process, finished goods.
All of that. Or for receivables, the money other people owe the company. This note will show you the total amount minus the allowance for doubtful accounts, which is management's guess about how much they'll never collect.
And that allowance is such a critical window into how aggressive or conservative management is being. I bet this note can also show you some really important operational trends.
Oh, it reveals everything behind that single number, including things like seasonality. You see this all the time with retailers. Their annual income statement might look steady, but this note might reveal that 40% of their sales happen in the fourth quarter.
The holiday season.
Right. And that detail completely changes how you think about their operations and their cash flow during the rest of the year.
All right, let's talk about the landmines. Note type 3, disclosure of information not recognized. This sounds like where the hidden risks live.
It is. This is the section for unquantifiable risks. The question it answers is, what major risks or future events are just too uncertain to reliably put a dollar number on? This is all about disclosure, a story, a narrative warning versus recognition, which is a hard number on the statements.
Give me an example of a huge risk that doesn't get a number.
Pending litigation is the classic one. A company like Altria might be facing thousands of lawsuits. The total potential cost could be billions, but since the outcome is so uncertain, they can't put a liability on the balance sheet.
So what do?
Instead, they have to provide these extensive, detailed narrative notes warning you about the potential severity and status of all those legal cases. If you skip reading that note, you are walking blind into a potential financial disaster.
And finally, the forward-looking stuff. Note type 4, supplementary information. This is where we learn about the strategy, maybe, the future.
Exactly. This answers what strategic or operational information is vital for assessing future performance, and this includes crucial data like business segment information.
Ah, okay. Like if you're analyzing Amazon, you see their huge profits, but this is the note that tells you how much of that is from the low-margin online store versus the incredibly high-margin Amazon Web Services, AWS.
Precisely. Without that breakdown, you are analyzing a black box. This note also gives you geographical segment information, which helps you assess political risk, and for resource companies, it has critical operational data.
Like for ExxonMobil.
For a company like ExxonMobil, their note will detail the volume of their proved reserves of oil and natural gas.
And while that's not an asset on the balance sheet yet, it is the single best indicator of their future revenue. That's vital for any kind of valuation.
It's the lifeblood of the company, and it lives in the notes.
So what does this all mean for you, the listener? We've got these 3 statements, we have the auditor verifying they're fair, and then we have the notes providing all this critical context.
It means you have to view all these pieces as one interconnected whole. It's a concept we call articulation. The statements are pretty much meaningless without the auditor's credibility check, and that check is incomplete without the notes explaining all the assumptions and flagging the risks. Real financial literacy means treating those notes as being just as important as the bottom line number.
And as we wrap up, we've touched on this term, materiality, this idea that only information significant enough to influence a user's decision actually needs to be disclosed.
And that raises a really important question for you to think about. Since it's management and the auditors who ultimately apply that definition, they're making a subjective judgment call about what's significant enough to tell you. So how does that inherent judgment, that decision of what clears the bar of materiality, affect the overall transparency of a company's financial story? It's a key philosophical puzzle at the heart of financial reporting, and it's definitely something to keep in mind the next time you open an annual report.